Okay, so that's the 2 minutes. So to recap, the question was, in terms of accounting, how would you classify a building? So each of you are going to give me your answer. Um, so who want to volunteer before I'll make my selection? But all of you are going to answer. So you might as well. You can either be first or last, or you can be in between. So what? Who want to go? Who want to volunteer? Anyone want to volunteer? Ashita, Fakir. Okay, Fakir, it looks like you're going to volunteer.
Yeah. So in terms of accounting, I would classify a building as an asset, obviously.
Uh,
Um,
so say again. You will classify.
I would classify a building as an asset,
Okay, and then.
and it's an immovable property, of course. So it's a non-current asset sitting on the balance sheet.
So then you will
Uh,
classify. So okay, so you said an asset. I can't hear so clearly. So you said an asset, and then.
yeah, and it's an immovable property, obviously. So it's a non-current asset, right? And
Okay.
then you get other things like ownership and those things. But if you're just asking for classification,
Yeah.
then
So,
it's an asset.
so an asset, and then and in terms of accounting standard, which accounting standard?
For buildings, is it IFRS 16? I mean ISO 16. Am I
Um,
correct?
but yeah, but like, what's the name?
Uh, what's it? PPE, right?
PPE.
Correct.
Okay. So you're
Yeah.
saying if someone asks you for a building, you can classify it as an asset, and so it's an asset, and therefore its actual classification would be PPE I-16. Okay, so that's your answer. I'll respond to you on everyone's answer afterwards. Okay, want to go next? Anyone else want to go next? Sheeta says I-16 PPE. Lerato.
I just got in. I was experiencing some problems connecting to this
Okay,
thing. What was the question?
so the question is, how would if a question had to ask you in terms of accounting, how would you classify a building? What would your response be? So Mahlati, you said PPE fixed asset. Okay. So Fakir, asset,
APP.
PPE, Ashita, asset, PPE, Mahlati, asset, PPE. Lerato, you have a response? You need some time to think still.
Yeah, it will be PPE.
PPE, okay. Tandi, an asset as defined under PP that can be used, okay. Um, Ryan and Valise,
I would also classify it as other under ISA 16 property, plant and equipment as a non-current asset.
okay.
The same actually non-current asset, yes, PPE.
So you say same actually, what did I have before that?
No, it's the same.
Oh, okay. Okay. So you all went with that. I'm gonna choose randomly now, and I want to give me your reason. Okay, so Fakir, you went first, so why PPE?
Um, it's a fixed asset. I can't really think of anything else.
You just okay.
Uh, yeah. Uh,
Tandi, can you give me why PPE? I think you gave me a reason. You stay quickly. Um, and the PPE again, okay, can be used. Okay, okay. So this was the reason why I asked that question. It wasn't exactly straightforward. So the one aspect is right, it is an asset. But in terms of a classification, the correct based on my question, the correct response is most likely an asset. But in terms of classification, which type of an asset, the correct response is it depends. It is not necessarily IS16. The correct response is it depends. Why is the correct response it depends? Because an asset is classified based on the nature. I never told you what's the nature of a building. I just said a building. For example, if a company uses the building to produce for in the production of the income or just occupy it, then it will be PPE. But that very same building, someone else is maybe leasing it to, or for example, the very same building, another company owns it but leases it out. So they have a building to earn rental income and to earn capital appreciation. So then for them, the building is investment property IAS 40. Another company can also have a building, but for them, they're in the business of selling buildings. So to them, buildings would be inventory. So you might just remember, you need to always ask yourself, what is the nature of the asset? And from there, you can determine the classification, because the same type of asset can be something different to someone else. So like I said, a building for one company can be inventory, for another company can be investment property, and for another company can be PPE. So it will be PPE if it's owner occupied or used in the production of income. It would be investment property if they hold it to earn rental income and or capital appreciation. And if it's part of if they sell buildings in the ordinary course of business, then it would be inventory. So it's very, very important that when you look at an asset, it does not necessarily mean you see a vehicle, then it's PPE. It depends on how they use it. Okay, what's the intention from management? So for one company, vehicles would be PPE. For another company, vehicles could be inventory because it's selling it in the ordinary course of business. But vehicles can't be intangible assets because it is tangible. Buildings can't be intangible assets because it is tangible. Vehicles can't be investment property because it is not a fixed structure. So that's how you need to think about it. Similarly, building and a vehicle cannot be a financial asset because it doesn't meet the definition of a financial asset. A financial asset, one of the definitions is that that there must be cash on both sides. So if you have an asset, you must be receiving cash and the other party must be paying cash. That's one of the definitions. So therefore you can see for a vehicle, if you buy a vehicle, the parties may be receiving cash, but you're receiving a vehicle, which is non-cash. So it can't be a financial asset. So you must just make sure when you classify, that's the level of thinking. What is the nature of the asset and and must run through the various definitions. So as we go through, we will cover a number of asset standards and you must see whether it meets. So I purposely asked that. So I wanted you to get your thinking. So not necessarily PPE, it could have been inventory, it could have been an investment property. So the correct response is or was, it depends. Okay, so that's the response. Anyway, so I hope you understand that now. So let's get into inventory. So are you guys happy with that? Do you have any questions before we move on? Okay, I'm assuming you're happy.
No.
So now let's talk about inventory. So I'm going to run through it quickly because we covered quite extensively in that one free Zoom class. But basically, you need to understand the definition of inventory. But before you get to the definition of inventory, that item first have to be an asset. So once it is an asset, now you can classify it as one of the assets. And for this particular asset to meet the definition of inventory, it must be sold in the ordinary course of business. It must be used in the production of inventory. It must be used in the production process. Sorry. So something is inventory if it's used in the production process. Something is inventory if it is sold in the ordinary course of business. Okay. And then there would be another definition of inventory. So basically consumables and packaging. Those are kind of minor stuff they can also be classified as inventory. So that's important to note. What is the definition of inventory? Now, with every particular asset, the thinking process is broken up into three parts: initial recognition, subsequent measurement, and derecognition. So for every asset and basically every liability, that's the three stages. Initial recognition, when it first come onto the books. Subsequent measurement, how you deal with the asset during its lifetime on your books. And then thirdly, derecognition, how do you remove it from your books? Okay. So at initial recognition, we're focusing on two aspects. When to recognize and at what amount. So when do you recognize? You recognize inventory when the risks and rewards of ownership transfer. So you recognize inventory once you gain control. You gain control when the risk and rewards of ownership transfer from the seller to you, the buyer. And so that is basically, and typical examples of risk and transfer of risk and rewards is basically the shipping point, FOB shipping, FOB destination. FOB shipping is when the goods are loaded onto the mode of transport. FOB destination is when the goods arrive at an agreed upon destination. Okay, so basically those are the typical two ways risk and rewards of ownership transfer. Okay, then the question is, at what amount? At what amount do you recognize inventory? It is basically, the general principle would be all costs incurred to bring inventory to a place and condition ready to be sold. So this typically would include purchase costs. It would include import duties. It would include, what did I say? Purchase cost, import duties, and transport costs. Okay. You will exclude any amounts that you will receive back. So for example, as a VAT vendor, so Pick n Pay is a VAT vendor. So when they buy Coke from Coca-Cola, they will pay Coke an amount inclusive of VAT. However, because Pick n Pay is a VAT vendor, they will be able to claim the VAT back as a VAT input, and hence it is not a cost incurred. So therefore, whenever you have VAT and the company is a VAT vendor, you need to exclude VAT from the purchase price. However, must exclude VAT from the cost of inventory. However, if you are not a VAT vendor, then you won't be able to claim the VAT back. So then the VAT becomes a cost incurred. Okay, that's very important. Then the cost of inventory would also include, or basically it will reduce the cost of inventory any discounts received. Okay, so it's a discount received for early settlement. It is a trade discount or a volume rebate. So there's a difference between trade discount and volume rebate, and a settlement discount. A trade discount and a volume rebate, you basically know at the time of the purchase that you're getting the discount because you're buying a certain number of quantity. Okay. A settlement discount for early settlement only arises at the point in time when you settle early. So for example, Pick n Pay have an agreement with Coke that they can pay after 30 days. But Coke will say, if you pay within 7 days, you get a 10% discount. So that discount will only be granted when Pick n Pay pays within 7 days. If Pick n Pay does not pay within 7 days, it will not be granted. So that discount is also allowed to be, you're also allowed to reduce a discount from your cost of inventory. So just be aware of that. However, any rebate that the company receives, so any rebate that a company receives from the supplier because of a selling cost, that cannot be reduced. So typical examples, I didn't know about this. I only came to know about it when I was in audit. And I audited inventory. So inventories are huge. It's a high risk item in the audit environment. If you're dealing with a retailer or manufacturer, So then I only realized. So for example, Pick n Pay have Coke on the shelf. Pick n Pay wants to sell Coke. However, because Coke is on the shelf, they charge Coke an advertisement fee. Okay. So that is why, depending where on the shelf you are, depending where in the store you are, there's a different marketing fee that Pick n Pay would charge. So you will see the bigger brands generally right in your face, is generally on a shelf that is eye level. So eye level is going to pay a higher marketing fee to Pick n Pay relative to someone that's right on top or perhaps right at the bottom. So that there's agreed upon fee based on volume sold and all of those type of things. So I think every quarter at the hardware store where I was auditing, every quarter PPC would provide this hardware store with a rebate. But this rebate was twofold. So there's two types of rebates. One, a volumes rebate based on how many items they bought from PPC. And then the second one was a rebate for advertising. So the volume rebate, that rebate must reduce the cost of inventory. However, the marketing rebate must not reduce the cost of inventory, because the marketing rebate is not a cost incurred to bring inventory to a place and condition ready to be sold. It's rather a selling item, a selling cost. So just be aware of that. Obviously, it's not a cost to the hardware store, it's an income to them. But so with the rebate, the journal entry would look as follows. So with a volume rebate, it will look as follows. Debit bank, because they're receiving money. Credit inventory, it reduces inventory. With the marketing rebate, it will be debit bank, because they're receiving cash from PPC, but they're not going to credit inventory. They can't impact inventory because it's not a cost incurred in the production process, but rather it is a selling cost. So they will credit other income or they will credit other expense. So just be careful on that. They do bring it into the exams, so you must just take note. Okay.
I just maybe have a question on that. Fakir. I just have a question on that now.
Yeah.
Sure. So for example, for Coke or the PPC people, technically they are benefiting from that promotion that you're doing, isn't it? So why don't we capitalize that cost against our inventory or net it off from us? Because they're the one that benefit from that technically. Because we would naturally sell their products in any case, whether we promote or anything.
Yes. So, but the thing is that it is, once it's in the store, it's already in a place and condition ready to be sold. So that is all basically a selling item. So is any selling income, any selling cost cannot form part of the cost of inventory.
Okay.
So the selling related item. That is why the marketing fee that you get cannot be reduced. So why I tell you why this is important, because I'm going to show you the standard now, but I won't be able to show you the thing I wanted to show you, because in the books, in the IFRS book, I don't know if you have your handbooks, you will generally see right at the bottom, there will be some extra notes. Now you must always read those extra notes, because that is basically notes from the IFRIC. The IFRIC is basically the guys that do further interpretation on the accounting standards. So for example, a standard comes out. Then people read it, like people in the real world read it, and then they like think, actually, we're not sure how to treat this. Then they send a question to the IASB. The IASB forward it to the IFRIC committee. And the IFRIC committee will look at the question that the real world is asking, and they will provide a response. And then the answer to the response in subsequent years will be at the bottom of the book. Why it will be at the bottom of the book is not really part of the standard as yet. It's only the board of the IASB can issue standards, not the IFRIC. So many examiners will use those questions at the bottom. So if I show you quickly, so yeah, I have this old book, so I don't know it will be in your one. So in IAS 2, that exact question comes up. I wanted to show you on the online I4S, but it's not on the online I4S. So I don't know if you can see. So this is the standard, okay? So this here is a standard. So here they talk about the cost of inventory and they talk about the cost of purchases. So in here, so here at the bottom, if you look at the last sentence, trade discounts and all of those stuff. And then over there, I have E1, E2, E3. So that is now the IFRI committee. So if you go to the bottom over here, here's the E1, E2, and E3. So that E2, E1, and E3 tells you how to treat a trade and volume discount. So because of that being there, many examiners is going to throw this into the exam because they expected you to read it. So just be aware of that. And that very issue on volume rebates, trade discounts, and selling discounts is made mention of over there. So I'm just telling you, so you're aware. We'll cover that in the question and then I'll explain to you further. Okay. So that is the cost of inventory. Okay. At what amount? It is all cost to bring inventory to a place and condition ready to be sold. So just take careful note of the discounts. Now we go on to subsequent measurement. Before I get to subsequent measurement, I want to get to derecognition. So remember, inventory can be derecognized in two ways. Through sale. So when you make a sale, you will say credit inventory because inventory is an asset. Inventory is reducing, and asset reduces on the credit side. For every credit, there must be a debit. The debit for cost for inventory is cost of sales. So inventory and cost of sales go hand in hand. So the debit goes to cost of sales. Okay, so that is how inventory reduces, gets derecognized. The second way inventory is derecognized through a complete write-down. So for example, then let's say there's a one of the warehouses burned out, okay, to a point where the goods is beyond destroyed, there's nothing they can do. So therefore, inventory is no longer an asset because there's no longer future economic benefits. So you have to reduce the future economic benefits. You have to write it down to zero. So assets are being reduced. Assets, in this case, being an inventory, and assets decreases on the credit side. So I'm going to credit inventory with the write down. For every credit, there must be a debit. This debit relates to a write down, but the write down forms part of cost of sales. So we're going to say debit cost of sales, credit inventory. That's why when you enter the real world, there will be there'll be different line items called cost of sales. They will say cost of sales, actual sales, cost of sales, write down, cost of sales, whatever. So depending how management wants to review their numbers, they know that cost of sales is made up of different amounts relating to inventory and not solely purely sales. So therefore, they split it out in order to identify which cost of sales or how cost of sales is made up. So just keep in mind, almost every expense, write down, sale is taken to cost of sales when it comes to inventory. So that is derecognition. Now we come to subsequent measurement. Under subsequent measurement, the simple principle is inventory is subsequently measured at the lower of cost and NRV. So inventory is measured at the lower of cost and NRV. What is NRV? NRV is net realizable value. So when it comes to year end, you must have the cost amount, and then you ask yourself, is there any write down? What's the NRV? NRV is normal selling price less cost to sell. Okay, so NRV is normal selling price less cost to sell. So the moment NRV is lower, you have a write down. If cost is lower, there's nothing you need to do because you're already at cost price. Some further aspects when it comes to subsequent measurement and so forth is how do you cost inventory? So remember, there are three methods to cost inventory. Number one, first in, first out. Number two, weighted average, weighted average cost, WACC, weighted average cost, something like that. And then number 3, specific identification. Specific identification will generally be like a vehicle shop. There's not many items of inventory, and you can kind of specifically identify products. So for example, if we go to second-hand shop, they don't have like hundreds of the same car. They maybe have 100 cars, but each one is different. So they should be using, would make sense to use specific identification. But when you have a large quantity of the same item, then we will use either WACC or FIFO. Okay, so just be aware of that. So now I'm going to go over to the question, and then we will we'll go through more detail. So while I go over, if you have any questions, you can just let me know. So we're going to go to page 111. So it is FAQ 4863, test 1, 2018. So we can go to page 111. We're going to do client 2, Juice Limited. And tell me once you're ready. Can we continue?
Yeah.
Okay, guys, in any case, we'll go through. So they say Juice is one of the largest fruit juice producers in South Africa. The company has a 31 December financial year end and is listed on the Johannesburg Stock Exchange. So important 31 December year end, and they're a listed company, and they're the largest fruit juice producer. Juice purchases their fruit from the various farmers, and only the best quality fruit are selected to enter the production process. Any substandard fruit that do not enter the production process are sold to surrounding farmers as animal feed. The previous year's financial statements indicated a closing balance for raw material, which is fruit, of 2.8 million carried at cost, and for finished products of 3.5 million carried at cost. So last year's closing balance is this year's opening balance. Since Juice closes for the December holidays, there are no work in process at financial year end. The fruit juice is ready to be sold once it has been packaged. Juice purchased fruit to the value of 3,755,000 rand during the current financial year. One of Juice's regular suppliers, Mr. Golden, had an exceptional harvest and sold 600,000 rand worth of apples to Juice, which is included in the 3.7 million rand. Due to early payment, Juice received a 5% on the 600,000 rand as discount that was allocated, that was allocated to the discount received account under other income. Okay, so you might just be aware over here. It shouldn't have gone to, yeah, so it will go to other income, but remember it reduces. What does it reduce? It reduces inventory. So just keep that in mind. Okay, so it reduces inventory. Upon the receipt of the above mentioned apples, 2 crates of apples amounting to 5,000 rand before discount Okay, I'll read this properly. Upon the receipt of the above mentioned apples, 2 crates of apples amounting to 5,000 Rand before discount each were only half full. Okay. Jules was refunded for the loss in apples. So let's break that down. So there's a few important things. There's 3 important things over there. Number 1, that we have purchases of 3.7 million during the current financial year. Number 2, included in that purchases was a purchase of 600,000 Rand, of which we received a 600, we received a 5% discount on that 600,000 Rand. So the 600,000 Rand is included in inventory, but it should actually be 600,000 Rand less the discount. So the discount will be moved out of other income and be included in inventory. Okay, so we need to reduce our inventory balance. And then number 3, that we paid for 2 crates, 5,000 Rand each. However, the crate was not full, it was half full. So therefore they refunded us for basically for 1 crate. So we must take that into account. So there's 3 important things to take note. Okay. A normal spillage amounting to 25 cents per liter of the quantity that entered the production process occurs with the packaging of the fruit juice. So that's important to note. Any normal spillage is allowed to be included in the cost of inventory. The moment the spillage is more than 25 cents, that amount above 25 cents is no longer considered normal spillage. It's considered abnormal spillage. That should not form part of the cost of inventory. That needs to be expensed. Okay, so that's important to take note. Then they say the inventory count at the financial year end indicated the following. 500,000 Rand worth of fruit was identified as substandard. So 500,000, that's the cost price, and will be sold for 150,000 Rand as animal feed early in the following financial year. So now that's important. We can see we have a cost of we have inventory that costs 500,000 Rand that has been identified as substandard. That implies there's an impairment impact. Okay. So what is the impairment impact? We need to have a look. What is NRV? So they're telling you that it can be sold for 150. So the 150 is NRV. So we have a cost of 500 and we have an NRV of 150. The inventory needs to be measured at the lower of cost and NRV. Which one is lower? NRV. So inventory needs to be at 150. So to get from 500,000 to 150, we need to put through NRV journal entry. So the NRV journal entry would be as follows. Credit inventory, because inventory needs to reduce by 350,000 Rand. So credit inventory, 350,000 Rand, and debit something, 350,000 Rand. That something must be an expense. What do we call that the expense? The expense relates to a write-down, NRV write-down, but any expense-related item affecting inventory goes through cost of sales. So we're going to be debiting cost of sales with 350,000 Rand. Are we okay with that? Any questions? If you have questions, just let me know. Okay. So now we go, next bullet point, the closing balance for raw material amounted to 1197. So they're giving that to us. And then we will have the third bullet point, 50% of the finished products manufactured in the current year were the only finished products on hand at the financial year end. So to get the closing balance of finished goods, we're going to have to get the production costs for the year. So we're going to get the total production costs for the year, multiply that by 50%, and that amount is the is what finished goods, the closing balance of finished goods equals. Okay, so just take note. When they say at year end, Juice pledged 500,000 Rand worth of inventory as security for a short-term loan. So why that's important? If you have to disclose inventory. So when you disclose inventory, so let's, before we move on, You must know that inventory is a balance sheet item. So on the statement of financial position, under current assets, you will have one line item called inventory. Okay. But in the notes to the financial statement, you need to provide the various categories of inventory. So for a manufacturer, the categories of inventory would be raw material, work in progress, and finished goods. For us, in this question, it will be raw materials and finished goods. There won't be work in progress because I told you that at every year end, there's no work in progress. Okay, so remember, on the balance sheet, there's one line item, inventory. But in the notes to the financial statement, under the note of inventory, we have to break down what makes up the balance. So the balance could be made up of raw materials, work in progress, finished goods. It could be made up of any consumables, such as consumable stores or packaging, and it could be made up of purchases or merchandise. So for example, if you go look at Pick n Pay, they won't show raw material, work in progress, finished goods, because they're not a manufacturer. They're a retailer. So they will just show, call it merchandise. Okay? And there may be other smaller items. So just be aware of that. And then below the inventory note, you will have to include some items. So for example, you need to include if there's any amount of inventory that has been pledged. So in this case, 500,000. So you will say the company has pledged 500,000 rands worth of inventory. The second thing you need to show how much of inventory has been recognized as an expense. Basically, what is the cost of sales figure? So you must show what the cost of sales figure is. We don't have it here, so we'll make up, we'll just write the sentence and then make x, okay? And then another important aspect is to make mention of any write-down and what is the NRV. So you can see the NRV in this question is 150, but the write-down is 350. Okay, so you must make mention of that. And then another thing you must make mention of is any reversal of a write-down. There's no reversal of a write-down in this question, so we don't disclose anything. So those are the typical disclosures. I'll show you now in the accounting standard, but I just wanted to mention over here. So now let's move on. So here they give you other information relating to the year ended 31 December 2017. So they say income received from the sale of substandard fruit. The cost price is 430, amounting, okay, and they sold it for 185. Now just be careful over here. We only do NRV write-downs when we're dealing with year-end inventory, okay? Over here, we actually got rid of the inventory, so there's nothing to write down. We just get rid of the full balance. Although we sold it for 185, the cost that we get rid of is, the amount of inventory that we get rid of is the cost price. So we got rid of 430. There's no need for a write down because the inventory is not, the fruit is no longer sitting in inventory. It is gone. So we write it off completely, okay? Then we have delivery costs. Fruit collected from farmers. So remember, fruit collected from farmers, we need the fruit for the production process. So in order to have the fruit, we needed to have it at our warehouse. So the cost incurred to get it from the farm to our warehouse is a cost incurred to bring the inventory to a place and condition ready to be sold. Without the transport costs, we can't produce juice because the juice is produced at our factory, not at the farmer's farm, okay? Then we have the delivery costs, finished products, fruit juice delivered to customers. So that is a selling cost. So therefore, we will not include that because the juice is already in a condition to be sold. So any selling cost is not included in the cost of inventory. Then we have fixed costs. Fixed cost is broken up into finished product storage costs. We will include that because without storage costs, we can include storage costs because we will need it. And then depreciation, property, plant and equipment, manufacturing. Because it's part of the manufacturing process, we will include it. Then we have property, plant and equipment, other. So other meaning it's not part of the manufacturing process, so we cannot include that depreciation in the cost of inventory. Then we have normal capacity, 600,000 of liters. Then we have actual capacity, 450,000 liters. This capacity story is used to allocate fixed costs. So there we know fixed costs, which is the depreciation. So the depreciation, so the depreciation cost of what's the depreciation of 850? We can't include the full amount. We have to include it based on actual as a percentage of normal capacity. But we'll explain that when we come to the question. Then we have variable costs. I'm assuming it's also part of inventory. I mean, it's a manufacturing cost, but they're not saying anything else. So therefore, any manufacturing cost is part of the cost of inventory. Then they talk about actual spillage at the end of the production process. You can see it ends up being 45 cents. Now, we can only include 25 cents in the cost of inventory. The other difference, which is 20 cents, needs to be taken out of the cost of inventory, but you can't include abnormal spillage in the cost of inventory. I'll show you how to deal with that now. And then we have sales commission paid during the year. You can see it's a selling cost, and therefore it is not part of the cost of inventory. Before we go on to the required and tackle the question, do you have any questions before we move on? Nothing, okay. Now we go to the required. So part B says, disclose the inventory in the inventory note to the financial statements of Juice Ltd for the year ended 31 December 2017. Okay, so I'm going to go over to Excel. Tell me once you can see Excel. Can you see Excel? You should be able to see Excel. So they ask you to disclose. So therefore you need to show how it would appear in the statement of in the financial statements. So remember, when you disclose something, you need to state the it's the note to the financial statements. The note to the financial statements is part of a complete set of financial statements, and therefore need to follow the three things: company name, statement name, and date. So the company name, Juice Ltd. The statement name, it's the notes to the annual financial statement. Notes to the annual financial statements. And then every statement is for the period ended, except the balance sheet. The balance sheet is as at. So this is not the balance sheet, so it is for the period. The period is a year, so we say for the year ended. And which date? 31 December 2017. So remember, there's three things: company name, statement name, and date. So the for the year ended can be in the same line as the name of the statement. I just show it separate to clearly show you the three elements. Now we're going to disclose. Now we're going to disclose the inventory. So we're telling them this is the inventory note. So when someone look at the financial statements, they see the heading inventory. Now this is the manufacturer. So manufacturer would have raw materials, work in progress, finished goods. We don't show work in progress because the company does not have work in progress, so it's just raw materials and finished goods. Okay. And then that will give you the total. This total that we're showing over here, this total over here is basically what must be on the balance sheet. So when like when you're in audit and you have to, they call cost and cross cost financial statements. So one of the checks you will do that inventory on the balance sheet agrees to inventory in the notes. So you might just make sure that this total equals to the total in the on the balance sheet. Okay, so keep that in mind. Then we're going to have to state a few things. Okay, so you will say, you will make a few important info, some note disclosures. And number one, you must make mention what amount of inventory has been recognized as an expense. So meaning what amount of inventory has been recognized as cost of sales. That's number one. Number two, you need to state any write down. So in this case, we have a write down of 350,000 Rand, and then you must give its related NRV. So the NRV is 150,000 Rand. And then you must state any reversals. Okay, write down reversals. There's nothing in this case, so we don't show it. And then another aspect is to write down, to disclose any pledge. So in this case, we have a pledge of 500,000 Rand. Before we move on to the number crunching, I'm going to show you the how I know what to disclose using IAS 2. So I'll share with you the online version. So I just go fetch the online version from the SAICO website. Do you see it? Yes, you see it?
Yes.
Okay, so here you can see we have International Accounting Standard 2, IAS 2 inventories. Then they give you the objective. They say the objective of the standard is to prescribe the accounting treatment for inventory. A primary issue in the accounting for inventory is the amount of cost to be recognized as an asset and carried forward until the related revenues are recognized. So what they're trying to say, one of the main issues is how do you cost inventory, because inventory is recognized as an asset. Inventory is only de-recognized as an asset and recognized as an expense once a sale takes place. And then they say the standard provides guidance on the determination of cost and its subsequent recognition as an expense, including any write down to NRV. When you see something is underlined, it means there's a definition. Okay, so if I click on that, it's going to take me to the definition. It also provides guidance on the cost formulas that are used to assign costs to inventories. In your actual handbook, this won't be underlined because you can't click anything. This will be in italics. So anything that is italic would be, it means there's a definition in the standard for it. Okay, then they give you the scope, then they give you the definition. This one will come through. The following terms are used in the standard with the meaning specified. Inventories are assets. So there you see, inventories are assets. That means you must first identify or confirm that you have an asset. Once you have an asset, now you look to classify it. In terms of classification, you need to run through the various asset standards. So for an asset to be inventory, it's one of the three things. A, held for sale in the ordinary course of business. B, inventories are asset in the process of production for such sale. And then C, in the form of materials or supplies to be consumed in the production process or in the rendering of services. Okay, so that is the definition. Just here, NRV. NRV is the estimated selling price in the ordinary course of business, less the estimated cost of completion and the estimated costs necessary to make the sale. So like I said, NRV is the normal selling price less cost to sell. Okay, I'm not going to go through all the definitions. Okay, that's the only definitions over here. Then we have measurement of inventories. So you have a look at the cost of purchase. So first have a look here. When you see something in bold means that is the main idea. Okay. Everything that is non-bold is effectively giving further explanation on the bold. So if you want to get quickly an understanding of a standard, read all the bold paragraphs. That will give you the big picture overview. And then to get a little bit more detail, you read the non-bold. And then from the new standards, to know how to apply the standard, you look at the application guidance. IS2 is not an IFRS standard, it's an old standard. Only the IFRS standards have an application guidance. But IFRS have a standard, have Appendix A, which is the definition, and then have Appendix B, which is the application guidance. The standard of the IFRS is very, very short, but there's also bold and non-bold. So just read the bold to get the big picture overview. And then if you don't understand the bold and you want a little bit more detail, you look at the non-bold. If you want to know how to apply the bold and the non-bold, you must look at Appendix B, the application guidance. Remember, the standard, Appendix A and Appendix B is all part of the standard. Now, IS2 is the old standards, still part of IFRS, but it's the old standards, so they don't follow the new format. So you will see the definition is within the standard. They don't have an application guidance. You must take everything from the actual standard. So here, the bold, this is the basic principle. So the basic principle, the cost of inventory shall comprise all cost of purchase. Cost of conversion, so your conversion cost is your overheads and direct labor, and other costs incurred in bringing inventory to their present location and condition. So basically all costs incurred to bring inventory to a place and condition ready to be sold. Okay. So here they take you further. What is the cost of purchase? The cost of purchase comprise the purchase price, import duties, and other taxes, other than those subsequently recoverable by the entity from the taxing authority. Meaning, if you're a VAT vendor, you're paying VAT, but you can subsequently recover the VAT by claiming VAT input. Transport, handling, other costs directly attributable to the acquisition of finished goods, materials, and services. Trade discounts, rebates, and other items are deducted in determining the cost of purchase. Okay, so just be aware of that. You can read all the other stuff. I'm not going to go through this whole standard. I want to get to the disclosure. So just quickly, recognition. When inventories are sold, so when you de-recognize inventory, credit inventory, the carrying amount of those inventories shall be recognized as an expense in the period in which the related revenue is recognized. So this is the matching principle. When you have revenue, you recognize the related cost of sales. The amount of any write-down of inventory to NRV and all losses of inventories shall be recognized as an expense in the period the write-down or loss occurs. The amount of any reversal or any write-down of inventory arising from an increase in the NRV shall be recognized as a reduction in the cost of inventories, recognized as an expense in the period in which the reversal occurs. Okay, lots of words. So basically, cost of sales is made up of three things. Cost of sales is made up of when a sale takes place. Cost of sales is made up of when an NRV takes place. And cost of sales is made up of any reversal of a write-down of a previous, any reversal of a previous write-down. Someone send a message. Where's the chat? Why am I not getting the chat? Who sent the message? Okay, so, okay. So now let's come to this, to the disclosure, and we'll see what I want to cover, the disclosure. So once again, you can see paragraph 37, paragraph 38, paragraph 39 is non-bold. They're just going to give you some more information relating to the stuff above. So I'm just going to read paragraph 36. So paragraph 36, the financial statements shall disclose. Just important, remember, when it comes to presentation of financial statements is in, you look to IAS 1. IAS 1 also gives some general disclosure things, but any specific disclosures will be in the accounting standard. So the specific disclosures relating to inventory will be in IAS 2, but there will be also some general disclosures that IAS 1 may have. But how do you present financial statements? You look to IAS 1. How do you disclose specific items? You look to the particular standard. So in financial statements shall disclose the accounting policies adopted in measuring inventory, including the cost formula. So we must have a look that, so technically we should be disclosing that unless the question said, don't disclose it, okay? The total carrying amount of inventories and the carrying amount in its classifications appropriate to the entity. So we have the total inventory balance as we had the total balance, but we're showing the classifications in terms of raw material, finished goods, because those are the classifications appropriate to Juice Ltd. We must show the carrying amount of inventory carried at fair value less cost to sell. So that is showing the inventory at NRV, that is the 150,000 Rand. The amount of inventory recognized as an expense during the period. We don't know the total inventory recognized as cost of sales, but we need to show it. So we'll put a sentence there and we'll just make it XXX because we don't know the actual amount. Then we will say the amount of any write down of inventory recognized as an expense in accordance with paragraph 34. So that is the NRV amount. The NRV amount is the 350,000 Rand, going from cost price 500 to NRV of 150. So the NRV write down is 350. The amount of any reversal, there was no reversal. The circumstances or events that led to a reversal. So if there is a reversal, we must state the amount and then also give an explanation what caused the reversal, and then any carrying amount that has been pledged as security. So therefore we have that and we will disclose it. Okay, so that is the accounting standard that we're going to be applying. So over here, we will say, let me just go back to that thing. So I'm going to take that, I'm going to copy this. So I'm going to paste it here. So the first thing we're going to put over here is that the amount of inventories recognized and expensed during the current period is, we don't know. So we just put that there. Okay. The next, I'm going to copy and paste the carrying amount of inventories recognized as a pledge. That's what you do with disclosure. You just copy and paste the words of the standard and then make it relevant for us. So I'm going to put that over there. And we're going to say for like the amount of liabilities is 500,000 Rand. Done. Okay. Next, we know there's a write down. So here we're going to take that one. The carrying amount of inventory, we want that. So I'll just put it over there. So the carrying amount of inventories carried at fair value less cost to sell. So the carrying amount of inventories carried at fair value less cost to sell is 500,000 Rand. So remember, the cost price was 500, and then the fair value less cost to sell, the NRV is 150, but they're saying the carrying amount of inventory. So the inventories that is recognized in NRV, what is the carrying amount of them? So that 150, the carrying amount is 500,000. Then copy and paste another one. The amount of write-downs recognized as an expense. So what was the actual write-down? So we know the carrying amount is 500,000, but what was the actual write-down? So now we can show the actual write-down. Okay, we're not going to still say, we don't have to say which paragraph. So in the period is, so the actual write-down is 350,000 Rand. Remember how we got the 350,000 Rand? It is number one, the cost price is 500, NRV is 150, and hence the difference between the two gives us 350. So different companies have different ways of disclosing. Some companies will give the carrying amount of inventory, 500,000. Other companies will give the NRV. They will say the NRV, instead of showing the cost price, they will just say NRV is 150,000 Rand. Okay, so it doesn't matter. I just copied from the standard, and that is what I will write down. So there's all the disclosures complete. We're now doing part A. So remember, if you look at 36, if you look at 36B, the total carrying amount of inventory, is the bold, and then the carrying amount in classifications appropriate to the entity is the raw materials and finished goods. So we're happy with that. I just want to check one more thing. Why are we not just, let's just see, where's this question paper now? Here's this question paper. Okay, so please note your feedback should include any incorrect presentation and comparatives are not required. Narrative information is required related to information that was supplied in the question. Okay, cool. Okay, so that is fine. So we can have disclosures. So remember, we will have to disclose the cost. So for example, we have to actually disclose paragraph A, the accounting policies adopted in measuring inventory, including the cost formula. But based on what they said, you must include narratives based on what the question provided. The question did not provide us any cost formula. So, and they never provided us any measuring, any accounting policies. So therefore we don't still include it, okay? If they did have it in the scenario, then we would have to include paragraph A, okay? So now we can get into the meat, the actual calculation. But before we get into the actual calculation, do you have any question? Or we have any questions? You can just ask a question when you have. Now we're going to get into the workings on how we actually go about calculating raw material. Raw material is very, very quick because they told us the closing balance of raw material. They told us in this question, the closing balance of raw materials was at 1197, somewhere here. Where did I see that? So the closing balance of raw material is 1197,050. Go and plug that in immediately. So 1197,050, this here is given. We need to get the closing balance of finished goods, okay? The closing balance of finished goods, they told us, is 50% of the cost of production of the current year. So therefore, we need to go through the whole process in order to get the cost of production of the current year to get the 50% number. Okay, so I'm going to put here my workings. I'm just doing some formatting. Okay. So here I'm gonna have working one. So we're going to do basically T accounts for each of them. Okay. So we need to get finished products closing balance. They told us in the scenario the closing balance of finished products is 50% of the cost of production of the current year. So to get the cost of production, we have to do the work in progress account. But in order to do the work in progress account, we're going to have to do the raw material account. So we're just going to go through all the accounts. Okay, so we're going to go through raw material account. We're going to go through work in progress account, and we're going to go through finished goods account. Okay. So let's have a look. So I'm going to have the raw material. So we're going to do it like a, so the thinking process is like a T account, but I'm going to set it up in a normal table. So raw materials. So we're going to have opening balance. Okay. The opening balance increases. The opening balance is on the debit side of raw materials. Raw materials is inventory, which is an asset. Assets increase on the debit side and decreases on the credit side. The opening balance of an asset is on the debit side. It increases the asset. The opening balance was given to us as 2.8 million. Okay, so the opening balance, 2.8 million. 1, 2, 3. Then we had purchases during the current year. Purchases during the current year, which was given to us as 3,755,000 rand. Okay, so that you can see over there, 3,755,000 rand. Then they told us that included in that 3.7 million is a purchase of 600,000 rand, where we received a 5% discount. The discount, however, was taken to other income instead of taken to purchases. It's taken to inventory. So therefore, we need to bring that into inventory. So we're going to say early settlement. And it's going to reduce our purchases because we got a discount. So the discount is going to be negative. It reduces. How do we calculate it? The purchase price was 600,000 and we got 5%. Okay, what else is here? Let's go on. Then there's a 5,000 rand refund, which was before the settlement discount. So what we must know is a refund. So remember, like two crates were half full. So effectively, one full crate we never received. Each crate is 5,000 rand. So therefore, the refund will be 5,000 rand. However, this is relating to that discount purchase. So therefore, we're not going to get the full 5,000 rand as a refund. We're going to get 95% of the 5,000 rand as a refund. Okay, so the refund reduces raw materials. So I'm going to say equal minus 5,000 rand. But we're not going to get the full 5,000 rand. We're going to get net of the discount. So multiplied by 95%. So take note. 2 crates were half full. Effectively, we never received 1 crate. Each crate is 5,000 rand, so we're going to get back 5,000 rand. However, this transaction had a discount, so we're not going to get a full 5,000 rand back. We're going to get net of discount. Okay, so that covers everything over there. So we took into account the 3.5 million, the 3.7 million purchase. We took in the discount on the 600,000 rand, and we took into account the 5,000 rand refund. What's important to note, if the discount was correctly taken into account, then there's no need to deal with it. Okay, you can ignore it. Okay, so then we have normal spillage. We're not going to do anything with normal spillage at this point in time. When we come further on, we'll have a look where how we'll deal with the normal spillage. Okay. Then we have this write down. So remember, the fruit is a raw material. So the write down will be in the raw material account. So included in closing inventory is 500,000 Rand that has a write down. So keep that in mind. So included in inventory is, so we say the inventory count at the financial year indicated the following, that a cost price of inventory of 500,000 Rand was identified as substandard and will be sold for 150. So remember, so the inventory is on hand. The cost price is 500,000. We need it to be 150. We need it to be the NRV amount of 150. So what we're going to do, we need to move it. We need to reduce it from 500 to 150. So we put through a write down. Okay, so I'm going to put through a write down NRV write down, which goes to cost of sales. The write down reduces inventory, so it is equal to negative. I'm going to show the calculation. It is cost price minus minus the NRV amount. So we're writing it down to NRV. Okay. So that deals with that. We must bring into account the closing balance, and then the 50% relates to finished products. We'll come there now. So I'll just bring in the closing balance. Remember, the closing balance of inventory, the closing balance of an asset is on the credit side. The closing balance of an asset is on the credit side. The credit side reduces an asset balance. So therefore, we're going to make it minus 11,97,050. What we're trying to achieve, we are trying to achieve the amount of fruit, the amount of raw materials that is transferred to work in progress. That's what we're trying to achieve. So the way we achieve it is by reconstructing the T account. The way you reconstruct the T account is to put everything that should go through the T account in the T account. I am just putting it in a table. So if you want to reconstruct the T account, you use the exact same stuff I have here, but all the positives will be on the debit side, all the negatives will be on the credit side. And then when you balance the amount, when you balance the T account, that balancing figure is the amount that gets transferred to work in progress. So here I'll just say we're trying to get to the amount that is transferred to work in progress. Okay, but let's have a look if there's more things. There's still a table we need to get through. So let's go to the table. So remember, in this paragraph over here, we took into account the opening balance. The only number we must still take into account here is the opening balance of finished goods, and we'll do that when we get there. In this paragraph, we took into account everything. We took into account the purchases. We took into account the 5% discount on the 600,000 Rand, and we took into account the refund. This over here, this is just additional information that we will use later on. Over here, we took into account the NRV write-down of 350,000 Rand. Over here, we took into the closing balance because it relates to raw materials. This we will get back to when we deal with finished goods. So on this page, there's two things relating to finished goods: the opening balance and what we're trying to calculate, the closing balance, which we're going to use the 50%. And then we took this into account already in our note disclosure. Now we can move on to the next, to this table. So here they're telling you income that you received from the sale of substandard products, the substandard fruit, 430,000 Rand. So you receive 185,000 Rand. So let's understand the journal entry that happened. What happened here in that line item is you had fruit that was substandard. It's not of your quality. When fruit is not of your quality, we classify it as substandard. It needs to be written down. The way we deal with it is we don't use it in our production process to produce juice. We take that fruit and we sell it to farmers. So how much did we sell it to farmers? We sold it at 185,000 Rand. So assuming it was a cash sale, the journal entries would look as follows. Debit bank 185,000 Rand. Credit sales 185,000 Rand. That's the first part. So that's the first part, to recognize the sale. The second part is to recognize the cost of sales and de-recognize inventory. So the journal entry goes as follows. Credit inventory. Why are we crediting inventory? Because inventory have left our business to the farmers, okay, as a sale. So we credit inventory with the cost price 430. For every credit, there must be a debit. The debit to inventory is cost of sales. So we debit cost of sales 430,000 Rand. So therefore, when we are crediting inventory, which particular inventory account are we crediting? Because it is fruit, it is raw materials. So therefore, we're not saying the actual journal is credit inventory raw materials 430,000 Rand. So that is important to understand. We're not going to use the 185. We're not going to use the difference between 430 and 185. We are using the 430 because that inventory left the business. So we need to take out inventory based on the amount that is included in the inventory balance. The amount that is included in the inventory balance is the cost price of 430. So because that full amount left, we must de-recognize at 430. You need to contrast that with the NRV write-down. With the NRV write-down, we took the difference between 500 and 150. Why? Because the inventory did not leave our business. The inventory is still there. But we are saying that the future economic benefits of this inventory is not 500,000 Rand. This future economic benefits of inventory is 150, because that's what we estimate that we can sell it at to the farmers. So therefore, we reduce it to what we think we can sell it for. Whereas the 430 was actually sold. So we made the 185, and hence the full balance of inventory needs to leave. So what is the full balance? The 430. Very, very important to distinguish between the two. So this is going to say sale of substandard. I'm just going to call it that, substandard. So because it reduces inventory, I'm going to say minus 430. So please make sure you get that, eh? You must contrast the two. And the best way to identify what you need to do, think in terms of journal entries. But before you can think in terms of journal entries, you need to understand what actually took place. You need to understand the economics of the transaction. You need to understand what is the actual event. So just to reiterate, or to say again, over here is no transaction, but here is an event that took place. What is the event? That we identified inventory that costs 500,000 Rand, that is substandard. We can't use it in our juice production process. So we're gonna, any substandard fruit that we identify, we sell off to farmers, and we expect to sell this at 150. So the event that takes place is that we need to reduce our inventory balance. So why we reduce? So why do we use the difference? Because we currently have it at 500. We need it to be at 150. So therefore we reduce it by 350. Okay, so that's an event. It's not a transaction. Now with this one over here, This is an actual transaction that took place. What is the transaction? That we made a sale to the farmers at 185,000 Rand. The sale represents inventory that cost us 430. So because the inventory actually left the business, there's nothing left in our inventory balance relating to that. So therefore we write it down completely, and the amount included in inventory is the 430. So please distinguish between the two, okay? Now let's move on. Then we have delivery costs of fruit. So the fruit is a delivery, there's a delivery cost to the fruit. The fruit is raw material, so we can bring it in over here. Delivery costs. And that was, what was it now? The delivery cost was 230. So the cost was incurred. It increases the value of inventory, the cost of inventory. So therefore we add it 230. Okay. Let's have a look. This delivery cost we will not include because it is a selling cost, so it doesn't impact inventory. So it can't go through raw materials. It can't go through work in progress. It can't go through finished goods. And then we have fixed costs. Fixed cost is considered a conversion cost. Conversion cost does not impact raw materials. Conversion cost impacts work in progress. Then we have depreciation. Okay, then we have normal capacity, actual capacity that we use in our conversion costs. Then we have other variable costs. Other variable cost is also a conversion cost that impacts work in progress. Actual spillage, which happen in the production process. Anything that takes place in the production process is work in progress. So therefore, the raw material account is done. So we have taken all the items that impacts the raw material account on the debit side as well as on the credit side. So now I can sum them up. So by summing up, I'm getting, so by summing this up, I'm getting the balancing figure. So this balancing figure is the work in progress figure. So that is what we will transfer to work in progress. Now let's work out work in progress. So we do the same thing. We set up a T account. Work in progress is an inventory account, which is an asset. An asset increase on the debit side, decrease on the credit side. The opening balance of an asset is on the debit side. The closing balance of an asset is on the credit side. So working two, I'm going to have this. I'm going to say work in progress. So I'll start off with the opening balance. Remember what they said. This company has no work in progress at the end of the financial year, so opening balance will be 0. Work in progress is takes into account our production costs. Our production costs are made up of 3 things. If you think to management accounting, then the cost of a product is made up of 3 things: direct material or raw materials, direct labor, and manufacturing overheads. From a management accounting perspective, manufacturing overheads is either only variable or both variable and fixed. Now, it is both variable and fixed if we use absorption costing. IAS 2 inventories, the accounting standard, requires you to use the absorption costing system. Okay. So therefore, our cost of our product is still 3: direct material or raw materials, direct labor, and manufacturing overheads. But for an accounting perspective, manufacturing overheads is both fixed and variable. So when you think about management accounting, always know a cost of a product is 3 things: direct material, direct labor, manufacturing overheads. Manufacturing overheads is either only variable or both fixed and variable. From an accounting perspective, it is both fixed and variable. Okay, so that is what you need to think about. So that's what we're going to put in here, our production costs. Our production costs, direct material or raw materials, is what we calculated in working 1. So here I'm going to say raw material, and I just bring it from working one. So remember, raw materials increases the cost of a product, and therefore it increases the production cost. So for raw material, for work in progress is an increased work in progress, so therefore it is positive. So we covered direct materials. There's no other direct materials in this scenario. Then we must take into account the next cost of a product, which is direct labor. There's no direct labor mentioned in this scenario, so we ignore it. The third item that makes up the cost of a product is manufacturing overheads. But we split manufacturing overheads between fixed and variable. So let's start with variable. Variable manufacturing overheads. They told us it is 2 Rand per liter. So we say 2 Rand and we multiply it by actual liters. From an accounting perspective, we always use actual costs. From an accounting perspective, we use actual costs. So to get the actual variable overheads, we're going to say 2 Rand per liter multiplied by actual liters. If I remember correctly, the actual liters is 450,000 Rand. I mean, not 450,000 Rand, 450,000 liters. So let's just see. So remember on the first page, we took on the first page of the scenario, we took in on the first page of the scenario, it only spoke to raw materials and finished goods. Okay. So over here, we already took into account income received, that was raw materials. We took into account the fruit collected, that's raw materials. We're not taking into account the customer one because that is a selling cost. Then for we can take into account finished product storage. So there's a finished product. There's a fixed cost relating to a finished product, so we don't include it in work in progress. So the only fixed cost relating to work in progress is depreciation. Which one? The manufacturing. But before we get there, we took into account other variable costs, which was 2 Rand per liter. We multiplied by actual liters, which is 450,000 Rand. Now we can deal with the next overhead, which is fixed manufacturing overheads. Fixed manufacturing overheads must be, we need to use the capacity. We need to base it on a fixed overhead rate. Okay. So the way we're going to do it is as follows. We can see that the total fixed manufacturing overheads is the 850,000 Rand. What did I say now? The only fixed overheads relating to the relating to production costs is the depreciation, PPE, manufacturing. So that means the total fixed manufacturing overheads is 850,000 Rand. So when we go over here, we will say total fixed manufacturing overheads, in this case it's only one, is 850,000 Rand. However, when it comes to fixed manufacturing overheads, we can't just go put that amount as is. We need to use an overhead rate. From an accounting perspective, the way you work out the overhead rate is by saying multiplied by actual capacity divided by normal capacity or practical capacity. So actual capacity, 450,000 liters. Normal capacity, 600,000 liters. And that is your overhead rate. So your overhead rate is actual capacity divided by normal capacity. Another term for normal capacity, practical capacity. So that will tell you how much of overheads you can allocate towards the cost of inventory. We can't take the full overheads. We can only take the overheads based on actual capacity relative to normal capacity. The only time you limit your overheads based on the actual costs is if your actual capacity exceeds your normal capacity. So if actual capacity was not 450, let's say it was 700, then we would limit it to the total cost of 850. So just keep in mind. So therefore you can see we're not adding 850,000 Rand, we're only adding 637. So now we have taken into account all our production costs. We have taken into account direct materials, which we have here as raw material. We have considered direct labor. There's nothing in this question. And we have taken into account our manufacturing overheads. Our manufacturing overheads is made up of two things, variable and fixed. They gave us the variable cost per liter. We multiplied it by actual liters. Then we must find out what is our total fixed manufacturing cost. In this case, it was only the depreciation. We did not include the other depreciation, which is not a manufacturing cost, and we did not include the storage cost, because the storage cost is not part of the production process. The storage cost relates to finished goods. Okay, so therefore we have taken into everything. The only thing we need to take note of is that spillage. If it was only normal spillage, we do nothing, okay? Because the normal spillage is already factored into these costs over here. So normal spillage is already factored into there. If normal spillage was not included in there, you'll have to add normal spillage. But it is included in here because they didn't tell us it is not included. So what is happening is that this cost includes actual spillage. Okay, so this cost includes actual spillage. The actual spillage is 45 cents. However, we are only allowed to include in inventory normal spillage. So you need to ask yourself, is actual spillage equal to or less than normal spillage? If the answer is yes, you do nothing. If the answer is no, you need to make an adjustment for abnormal spillage. So we know normal spillage is 25 cents. Actual spillage is 45 cents. Therefore, our abnormal spillage is 20 cents. So we need to make an adjustment for that 20 cents. So basically the adjustments will look as follows. Abnormal spillage So the spillage is based in liters. So we must use liters. Which liters do we use? Actual or normal? Because we based with actual costs, we will use actual liters. So actual liters, 450,000. Okay. Multiplied by abnormal spillage. Abnormal spillage is actual spillage or total spillage minus normal spillage so it is 90,000 Rand. But an abnormal spillage does not increase your cost of your product, it must reduce the cost of your product. So therefore, we must subtract it. Why? The journal entry is as follows. With abnormal spillage, you will say credit inventory, debit cost of sales, because you can't include abnormal spillage in the cost of inventory. You must include abnormal spillage as an expense. Then we're going to put in our closing balance, because we have taken into account everything. We know the closing balance is 0, because I told you this company has no closing balances. And now we can work out what would be transferred to work in progress. I mean, transfer to finished goods. So just understand the process. You get your raw materials. Once you have your raw materials and you start your process, you have to transfer your raw materials into the production process. From an accounting perspective, we call that work in progress. Once the product is no longer in work in progress, it's ready to be sold, we transfer it from work in progress to finished goods. So just understand that intuitively. Your raw material is not your finished goods. It is what's used to get to your finished good. Okay. Then once that gets processed, once that gets transferred to the production process, the item is no longer raw material, but it can't be finished goods. It's not yet a completed product. So we take it into the work in process account. Once the process is completed and the item is ready to be sold, we transfer it out of work in progress and we take it to the finished goods account. So that's what we're trying to do over here. We want to get to the finish. What of the work in progress must be transferred to finished goods. So remember, this is in effect a T account. So we're just getting the balancing figure. The balancing figure is what gets transferred to finished goods. Another term that it gets used, it's the cost of goods manufactured. In accounting, we call it like this. In management accounting, we will call it cost of goods manufactured. So there we go. And basically, this total balance is all production costs. That total balance is all production costs. And we know our finished goods is 50% of production costs. So we can just simply say our finished goods is 50% of production costs. This is our production cost, which equals to the amount that has been transferred. So our closing finished goods is basically equal to that multiplied by 50%. So let me just explain. The question says that the closing inventory, the closing finished goods is equal to 50% of production costs. Okay. In this scenario, production costs equal the amount that is transferred to finished goods. The reason why that the production costs equal to the amount that is transferred to finished goods is solely because there's no opening and closing balance. What you should know, the production cost is this highlighted in orange. So production cost is three things: direct material, direct labor, manufacturing overheads. Manufacturing overheads is made up of fixed and variable. Why are we including abnormal spillage? Abnormal spillage is somewhere between raw materials, finished goods, whatever. I mean, abnormal spillage is part of the production cost, but it's relating to the raw materials. We just showed as a separate line item. So therefore, abnormal spillage is effectively part of raw materials or anything else. So it's part of your production cost. So remember, you must distinguish between cost of goods manufactured and production costs. Cost of goods manufactured can include movements between opening and closing. So just be aware of that. So that is the number we want. And let me actually just do this. So I'm going to go there. And this should be the answer. Let's hope. So this comes to working 3 and total inventory. That should be total inventory. Well, you can check the solution later. but that should be the answer. And that's the answer. You can check the solution. I think that would be the answer. Yeah, that's it from my side. Do you have any questions?
That's the question on the 500,000 that was pledged as a short-term loan. So shouldn't we remove that on our inventory because it's no longer inventory?
Now it is inventory. It just means that it is. It just means that you can't just do anything with inventory, but it's still an inventory balance. So it just means that if you want to sell it or something like that, you will have to first seek the permission from whoever you have provided the pledge, but it's still inventory. That is why you disclose it. So you can tell so when someone looks at your financial statements, they can see your total balance is 4.3, but 4.3 less 500,000 is what they can do anything with it. The other 500,000 they can't do as they please because it is pledged as security. Someone else have a right over it.
Okay.
Ryan, any questions? Belize, any questions? Who else is here?
No questions.
No questions. Can you send the Excel, please?
Yeah. Oh, someone sent me a message. We just see. Wait, I can see those messages. Okay, no questions. Tandy. And then Tandy's still here. Okay, but anyway, that's it from my side. So, so these are typical inventory questions. Make sure, so we covered 2 so far. We have covered the one from I'm gonna upload it as well, or you can watch it already. It's on YouTube from the free class, and then this one. Okay. Remember, you must also make sure that you do some questions. So just practice. Next week will be income tax. Okay. Thank you guys. See you.
Thank you.
Okay, bye-bye.
Thank you.